Paying off your mortgage does not mean your house is free. The bank may be gone, the payment book may be gone, but every year another bill shows up in the mailbox, and this one does not care that you are retired. Property tax. For a working family, it is annoying. For a retiree on Social Security or a fixed income, it can become the slow leak that drains everything. You buy the home, you stay put, you pay it off. Then assessments rise, tax bills follow, and suddenly the house you already own starts acting like it still belongs to someone else. But in some places, getting older can actually change that bill. Not everywhere, not automatically, and definitely not without paperwork. But certain states and counties offer exemptions, freezes, rebates, or deferrals that can make the yearly number much easier to survive. This is not a promise of free living. It is a map of 10 places where eligible retirees may be able to slow the bill down, cut it down, or at least stop it from pushing them out. Number 10. Florida. Florida is the obvious place to start because everybody already knows the retirement story. Sunshine, palm trees, golf carts, no state income tax, entire neighborhoods where the most intense local argument is whether someone parked too close to the mailbox. But property tax is where the Florida dream gets complicated. The state has the standard homestead exemption, and older homeowners may qualify for additional senior exemptions. In some areas, local governments can offer an extra exemption for homeowners 65 and older who meet income limits. In certain local cases, there is also a stronger long-term resident version for seniors who have owned and lived in the same home for many years. That sounds powerful. Here is where people get burned. Florida's senior property tax breaks are not automatic, and they are not statewide. A county or city may adopt the local senior exemption, but that does not mean every taxing authority in that area follows along. School taxes may still remain. Income limits apply. The owner has to qualify, apply, and often prove the numbers on paper. Florida is not move there and stop paying property tax. It is more like this. If you choose the right county, qualify for the right exemption, and actually file the paperwork, your bill may look very different from your neighbors. That matters because Florida is already expensive in other ways. Insurance can be brutal. HOA fees show up uninvited, and a lower tax bill does not help much if the roof policy eats the savings whole. Florida belongs on this list because it shows the first rule of retirement taxes. The state name is not enough. The county matters. And the paperwork matters even more. If Florida proves the county matters, Washington shows what happens when the neighborhood outruns the owner. Number 9. Washington. Washington is not usually sold as a cheap retirement state. The western side can be expensive, rainy, and full of home prices that make you wonder if the house comes with a secret gold mine somewhere in the crawl space. But Washington has something that matters for older homeowners. A senior property tax exemption system that can combine tax relief with a frozen home value. For many eligible homeowners, the program can reduce certain property taxes and freeze the taxable value of the home in the first year they qualify. That means the market may keep moving, the neighborhood may keep changing, and the county assessment may still exist on paper, but the taxable value used for the program can stop climbing the same way. That is the part retirees want to hear. The part they have to check is income. Washington's senior property tax relief uses county-specific income thresholds that can vary depending on where the home sits, and the program runs through local assessors. Two seniors in the same state may not get the same treatment if they live in different counties. Washington can be genuinely helpful for the right older homeowner, especially someone who bought years ago and watched the area get expensive around them. But it is not a blanket discount for every retiree. You need to be old enough, own and occupy the home, and fit the local income rules. Not a jackpot, more like a seatbelt. It will not stop the car from being expensive, but it may keep you from going through the windshield. Number 8. Oregon. Oregon's senior property tax program is built for a specific kind of homeowner, the one who is house rich and cash poor. Eligible senior homeowners may be able to defer their property taxes entirely. That does not mean the tax disappears. It means the state can pay the county tax bill on your behalf, and the unpaid amount becomes a lien against the property. The bill may leave the mailbox, but it does not leave the home. A deferral is not forgiveness. It is more like borrowing against equity, so you do not have to keep writing checks every year. The money generally has to be repaid later, often when the home is sold, transferred, or no longer qualifies. For someone whose house is worth far more than it used to be but whose checking account looks tired every month, that trade-off can be the difference between staying put and selling 5 years too early. Oregon has age rules, income rules, homeownership rules, and property value limits. But the core story holds. If the house has equity and the owner is cash poor, the state may help turn this year's tax bill into a later problem. That is powerful. It is also dangerous if misunderstood, because that later problem is still waiting somewhere down the road. Oregon can push the bill into the future. Minnesota asks a different question. How much of your income should the bill be allowed to take in the first place? Number 7. Minnesota. For eligible seniors, Minnesota's property tax deferral program can limit the amount paid out of pocket to a percentage of household income, while the state covers the rest as a loan. That is the kind of sentence that makes retirees stop scrolling. Because the real problem with property taxes is not just the total number, it is that the bill does not care what comes in every month. If the home value rises and retirement income stays flat, the gap gets ugly. Minnesota's program is built around that gap. It asks whether the bill is actually survivable relative to what the homeowner earns, not just what the house is worth. The homeowner may still owe taxes, the state may still place a lien, interest may still apply. This is not a magic eraser, but it can reduce the annual cash burden in a way that connects to real income rather than a county assessor's spreadsheet. You keep the home, you pay a manageable amount, the rest waits. But waits is the important word because the bill does not leave the property. It sits in the paperwork until a sale, a transfer, or a settlement. For the right retiree, that is a lifeline. For the wrong one, it is a debt wearing a helpful smile. Number 6. Tennessee. Tennessee is interesting because it does not just offer one kind of help, it can offer two at the same time. There is a state property tax relief program for qualifying elderly homeowners that can reimburse part of the tax bill. Then, in participating local jurisdictions, there may also be a property tax freeze that locks the tax amount at the qualifying year. One program helps with what you owe now. The other may stop the number from climbing going forward. For someone on a fixed income, that second part can matter more than the first. The worst part of property taxes is often not this year's bill. It is not knowing how bad next year will be, or the year after. A freeze changes that. Instead of bracing for the next increase, the homeowner gets a number they can actually plan around. But Tennessee is not one clean statewide program. The freeze is local. Not every county or city participates. Income limits apply, age matters, applications matter. The county decides whether the best options are even on the menu. That makes it more work to research. But for the right retiree in the right county, combining state relief with a local freeze can turn an unpredictable annual bill into something that finally sits still. Arkansas is about keeping a modest house affordable. New York is about surviving a tax system that was never modest to begin with. Number 5. Arkansas. Arkansas fits the channel's world better than almost any state on this list. Rural counties, small towns, lower home prices in many areas. The kind of places where a modest house can still look like a real plan instead of a financial hostage situation. But the tax story is why it belongs here. Arkansas offers a homestead property tax credit, and for qualifying homeowners 65 or older, the taxable assessed value of the homestead may be frozen. The credit helps now. The freeze protects later. Buying an affordable house is step 1. Keeping it affordable over the next 20 years is the harder part, and that is where the freeze does its work. The bill does not disappear. Millage rates can still matter. Improvements can still matter. But freezing the assessed value can protect older homeowners from being pushed out simply because the neighborhood around them got more expensive. Picture a retiree in a small Arkansas town. The house is not fancy. The street is quiet. The porch needs paint. There is one old pickup in the yard and a dog that has made peace with the heat. The whole point is that the owner can stay there without the tax bill becoming a yearly ambush. Not luxury retirement, survival retirement. Arkansas does not promise a tax-free life, but for the right homeowner, it may help keep the numbers from running away, and sometimes that is the difference between staying and selling. Number 4. New York. New York sounds like the wrong answer. High taxes, expensive counties, school tax bills that make people question every life choice that led them to owning property there. But that is exactly why it belongs on this list. When a state has heavy property taxes, relief programs can matter more. New York has enhanced STAR for eligible senior homeowners, which provides a larger school tax benefit than basic STAR. Many local governments and school districts can also offer a senior citizens exemption that may reduce the taxable assessment for qualifying homeowners based on age and income. School taxes are often the most painful part of owning a home in New York. A program aimed at that specific bill can mean something real, especially for seniors who no longer have kids in the school system but still receive the full invoice every year. You paid for the house, you paid for the town, your kids are grown and moved away, and the school tax still shows up like it has its own bedroom in the house. Local rules vary, income limits vary. Some exemptions depend on whether the local government chose to adopt them. Eligible seniors may be able to reduce school taxes through enhanced STAR and may also qualify for local senior assessment reductions depending on income and locality. Not as simple as taxes disappear, but much more accurate. And in a high-tax state, even a partial break can feel like someone finally loosened their grip a little. Number 3. Texas. Texas deserves a top 3 spot because its property tax story is almost unfairly dramatic. People move to Texas for no state income tax, big skies, cheaper land in some areas, and the general feeling that nobody is going to send them a letter about their mailbox color. Then the property tax bill arrives, and it is not subtle. Texas property taxes can run high, especially in growing counties, so the senior relief is fighting a real and visible problem. For homeowners 65 and older, Texas offers an additional over 65 homestead exemption for school district taxes, on top of the general residence homestead exemption. There is also a school tax ceiling for qualifying older homeowners that can limit how much those taxes rise. Eligible seniors may also have options to defer certain property taxes. Exemption, ceiling, deferral. 3 words that can genuinely change a retirement budget. A tax ceiling is not the same as paying nothing. Local taxes can still exist. A deferral postpones the bill, but interest and repayment can still follow the property. These are tools, not a clean exit. Still, the contrast is clear. In a state where property taxes are one of the loudest complaints, older homeowners get real options to keep the bill from climbing without limit. For anyone buying in a fast-growing Texas county, the question is not just can I afford the house? The better question is can I still afford the taxes when I am 75? Texas does not remove that question. For qualifying seniors, it may just make the answer less terrifying. Number 2. Washington, D.C. This one sounds wrong immediately. Washington, D.C. is not a quiet rural county. It is not where people go to escape modern life, unless their idea of peace involves gridlock, political noise, and a row house that costs more than a ranch in 3 other states combined. But D.C. has one of the strongest senior property tax relief stories in the country, and that contradiction is exactly why it is here. Eligible senior homeowners may qualify for a 50% reduction in real property tax. There is also a senior assessment cap that can generally limit taxable assessed value growth to a small percentage per year. For lower-income senior property owners, there may be a deferral option that can postpone the entire annual real property tax bill. Not because D.C. is cheap, because the relief can be unusually strong for a city that is anything but. Income limits and ownership requirements apply. The homeowner generally has to live in and own the property. The deferral can become a lien, meaning the taxes are delayed, not erased. These are real conditions, not fine print that disappears on a technicality. But D.C. makes a clear point. You cannot judge retirement taxes by reputation alone. A place can be expensive and still protect longtime older homeowners better than cheaper places do. The sticker price of the city is one thing. The tax code underneath it is something else entirely. But the top spot goes to the place with the cleanest, almost nothing story on the list. Number 1. Alabama. Alabama takes the top spot because it has the cleanest, almost nothing story on this entire list. Not for everyone, not automatically, but for qualifying senior homeowners, Alabama has some of the strongest homestead exemption language you will find anywhere in the country. Homeowners over 65 may be exempt from the state portion of property taxes, and under certain income-limited tiers, qualifying seniors may be exempt from all ad valorem taxes on the homestead. That is the phrase that matters, all ad valorem taxes. This is not a small rebate. It is not a delayed bill. In the right case, for the right homeowner, with the right income and homestead qualification, the property tax burden can be reduced dramatically. Alabama's rules have tiers. Income matters, county rules and local details matter. A viewer should not walk away thinking every senior in Alabama pays nothing. That is not how it works. The more accurate version is this: if you are over 65, own your homestead, and qualify under the proper exemption category, Alabama may offer one of the most aggressive senior property tax breaks in the country. And it fits the channel perfectly. Small towns, lower home prices in many areas, rural roads, older houses, fixed-income retirees trying to hold onto a home without getting bled every year by a bill that never seems to retire itself. The Alabama story is not glamorous. It is not a beach retirement brochure or a gated golf community with fountains and fake lakes. It is simpler than all of that. A house you can afford. A tax bill that may not destroy you. A place where getting older can actually mean the system backs off a little. And for a retiree who already spent a lifetime paying banks, governments, insurance companies, and everyone else standing in line with a handout, that might be the closest thing to freedom they are still allowed to keep.